This is not financial nor professional advice. This video is for entertainment only. Hey everyone, this market is one that is generally going down, and I think it's always going to be punctuated by what I call ridiculous rallies. And the best example of that was last week with Jerome Powell announcing that they increased interest rates 0.5%, and then it rallies wildly the next day because everybody's so relieved that 0.75 increase is off the table when he virtually promised about 3 half-point interest increases. So this market has formed what's known as a head and shoulders pattern on the S&P 500. Now, a head and shoulders pattern, it's just what it says. It's where you have an increase and then a bigger increase that forms the head, and then it comes down somewhat. And usually when it does that, it's getting ready to take a major dump, okay, to crash downwards. And this time is similar to, it's forming, the S&P 500 is forming a similar pattern to what it formed in 2008 before it took the big dip. Okay, not the big dip, the big crash. And that's what we're all looking out for. But we're in a similar situation. Now, the conditions are different. Now, they're different because of investor sentiment. Okay, back then, before the big crash in 2008, investors were bearish, but they were only about 60% bearish. Okay, right now, I think we have even more bad news. And so 80% of investors are bearish. And so the paradoxical effect of this is, if you get any kind of good news, any whisper of a good news, the market tends to rally. And in bear markets, they tend to be vicious rallies, or I guess you call them relief rallies. Oh, we're so relieved. It's like the man who's hitting his head against the wall, and you ask him, why do you hit your head against the wall? And he says, because it feels so good when I stop. Okay, we're getting hit by bad news, and then we get a whiff of good news. Oh my God, thank God it's not going to be as horrible as I thought. The SQQQ is a triple leverage inverse fund on the 100 largest companies on the NASDAQ. And the SQQQ tends to swing wildly, especially under these conditions. So I expected to drift downwards. If we get more bad news, that's just more reason for it to continue to go down. The estimation with the completion of this head and shoulders pattern, and this is what I've been thinking for a couple of months, is that it's going to go down below 3,800. And if the only thing that would change this is major good news, the war in Ukraine, Russia's invasion of Ukraine, that has ended. That would be that kind of good news that could change the pattern. We have something coming up that could affect the markets. We have to see how this plays out. But on May 11th, they released the Consumer Price Index, the CPI. And if that shows inflation, but it's not as bad as they expect, that could paradoxically, again, be good news. Hey, it's not as bad as we thought. And especially if we would get several months in a row where it's not as bad as we thought, it's not increasing as bad as we thought it could, you could get relief rallies and consecutive relief rallies that would drive the market higher. If it's shockingly bad news, like it's gone to 12% or something like this, beware, look out below is all I can say. timber is what you're going to see, the logs flying as they come crashing down, and there will be many logs still left in this forest of down stocks that could be falling. So but if it's just kind of expected bad news, well, we're still kind of in the unknown territory, unless the market just gets sick of all this bad news, and other bad news contributes, and then that drives it lower. So we need either shockingly good news or shockingly bad news to definitively drive it down, or an accumulation of bad news from different sources that would finally put the end to this. I want to call it a fake market because it doesn't seem real. You've got to have that capitulation, and we haven't seen the full capitulation. There's still people that, and it's tempting. You see these stocks at low prices, and I'm almost ready to buy, but I'm not quite ready to buy. But I will get there, and I may start buying slowly if this just looks like it's going to continue to go sideways forever. I may buy a stock I like here and there. Tesla comes to mind. That's always the first stock that comes to mind. And that's been vacillating a lot lately, going wildly up and then going wildly down, which is when you're below 1,000 points and it's going up and down by $100 or more. That's pretty wild. So what's driving the interest rates is inflation. That is the main problem. That is what they've announced, that they'll do anything to stop. And the inflation rate last time it came out in April was 8.5%. But another alarming thing was the producer price change. Producer prices went up over 11%. And that's worse because first the producers get price increases and they will absorb some of that to keep their business, but eventually they have to pass it on. So it's kind of built-in inflation that's in the system. And the things, there's hardly any good news on the inflation front. I mean, that food has gone up massively and continues to go up, and that's going up like 8.8%. Energy inflation, which is driving some of my investments. I'm investing in Exxon, and you could invest in any of the big major oil companies, and you're going to make money, so maybe you can buy gas. But energy inflation has been like 32%. So that's massive. Rent inflation has been about 5%. And that's on top of probably already unexpected and not tolerable increases. And what the Fed is trying to tamp down is inflation expectations. And they find that will drive inflation a lot, because if people expect things are going to cost more in the future, oh, man, you better stock up now. And I've done some of that already and made some major purchases based on the idea that it's going to cost more later. And right now, they're running at about 6.6%. Which is an increase in people's expectations, because the month before they were like at 6%. So you don't want to see that creep up, because people will change their buying habits. Things that they know they're going to need in the future anyway, you might as well buy as much as you can now. I will leave you with this chart that shows the inflation rate over the last 20 or so years. And you can see how inflation recently has doubled and even tripled beyond what it was. And that is why we're getting these interest rates, and why the Fed is going to try to slow down the economy. Be sure to like and subscribe so that you receive future videos. And thank you so much for watching. Good luck with your investing, and I will plan to see you in the future. Thank you.